Ever feel like you need a decoder ring just to, like, figure out what's happening with the global economy these days?
Yeah.
I mean, you're not alone.
Yeah.
So today we're going to hand you that ring.
Oh,
We're taking a deep dive into something called the Mar-a-Lago Accord.
okay.
Um, think of this as like your express route to understanding a significant proposed economic strategy,
Right.
one that's even drawing comparisons to the Plaza Accord back in 1985,
Right. Yeah.
a moment that really like shifted the global economic landscape.
Absolutely.
So welcome to the show.
Yeah. Thanks for having me.
We've got a lot to unpack here.
Yeah.
So we've been sifting through the details of this proposed Mar-a-Lago Accord.
Right.
And our aim today is to really bring you the core of it,
Right.
like what it's all about,
Yeah.
where it could lead,
Mm-hmm.
and why it deserves your attention.
Absolutely.
We want to give you a clear understanding of the key concepts and the potential impacts, both in terms of dollars and global influence,
Right.
without getting bogged down in the weeds.
Right. Just the meat and potatoes.
Exactly. So right off the bat, the name itself, the Mar-a-Lago Accord,
Yeah.
it certainly grabs your attention.
It does.
We know the term kind of started circulating in 2024,
Right.
and the name most associated with it is Stephen Marin,
Right.
economic advisor.
Mm-hmm.
But what were the brewing economic issues that made a proposal like this even, thinkable?
Yeah.
What's the backstory here?
Well, what's fascinating to consider is that this proposal isn't coming out of nowhere.
Yeah.
It really reflects growing concerns about a few key areas of the U.S. economy.
Yeah.
And I think you can boil it down to a few things.
Yeah.
So there's this feeling that the U.S. dollar might be stronger than it should be,
Okay.
which makes American goods pricier overseas.
Mm-hmm.
Then you have the persistent trade deficits,
Right.
the U.S. buying more from other countries than it sells.
Yeah.
And underlying a lot of this is this worry about the erosion of America's industrial base.
Right.
So the Mar-a-Lago Accord is essentially a proposed answer to these challenges.
And the name itself is kind of loaded,
Yeah.
linking it to Mar-a-Lago, former President Trump's residence.
Right.
That feels very intentional, doesn't it?
Yeah, it does.
It immediately evokes those America First principles.
It does. The name carries significant weight.
Yeah.
By referencing Mar-a-Lago, it strongly signals a connection to the America First economic agenda.
Right.
So it immediately tells you something about the potential philosophy and priorities driving this proposed strategy.
So let's get into the nuts and bolts.
Okay.
The Accord seems to have two main phases.
Right.
Phase one focuses on tackling those trade imbalances we were just talking about using tariffs.
Right.
How exactly would that mechanism work?
So the core idea of phase one is the imposition of broad tariffs,
Okay.
essentially taxes,
Okay.
on goods coming from countries that consistently sell significantly more to the U.S. than they buy.
Okay.
The source material specifically mentions China, Germany, and Japan as examples of the kinds of economies that would likely face these tariffs.
Okay, so the U.S. puts these tariffs on their products.
Right.
What's the intended effect?
Yeah.
What's the hoped-for result?
The primary goal is to put pressure on these countries to allow the value of their own currencies to increase
Okay.
relative to the U.S. dollar.
Mm-hmm.
The thinking is that if their currencies become stronger, their goods will become more expensive for American consumers.
Right.
Conversely, U.S.-made goods would become cheaper for consumers in those countries.
So it's kind of like trying to achieve a devaluation of the dollar without the U.S. government directly stepping into the currency market.
Exactly.
It's an indirect approach.
Yeah, it's an indirect approach. The intended outcome for the U.S. is essentially an indirect weakening of the dollar.
Okay.
By making American exports more price competitive on the global stage, the aim is to narrow those trade deficits and give a boost to domestic industries. Think of it as leveling the playing field a bit.
Right. Makes sense.
Yeah.
Now, phase two shifts to the issue of sovereign debt.
Okay.
This sounds a bit more intricate.
Yeah.
What's the proposed plan there?
Okay. So phase two centers around restructuring the U.S. government debt that is held by foreign countries,
Okay.
with China and Japan, again, being highlighted as major holders.
Mm-hmm.
The proposal suggests negotiating with these nations to exchange their current holdings of shorter-term and medium-term U.S. Treasury bonds
Right.
for new bonds that would mature much, much further in the future.
Okay.
We're talking about ultra long-term bonds with very low interest rates.
Mm-hmm.
A specific example mentioned is bonds with a 100-year lifespan.
100 years, wow.
Yeah.
That's practically forever in economic terms.
It is. It's a really long time.
What's the rationale behind locking in debt for such a long period at a low interest rate?
So the main objective is to ease the immediate financial pressure on the U.S. government. By converting a significant portion of the debt to these ultra-long-term, low-interest bonds, the amount that the U.S. has to pay in interest each year would be substantially reduced.
Right.
The idea is to make the debt burden more manageable over time,
Yeah.
while still maintaining the dollar's status as a key global currency.
Okay.
So it's kind of like a refinancing strategy in a way.
But the source material also flags a pretty significant potential downside here.
Right.
The risk of losing investor confidence and the dollar depreciating.
Yeah.
Can you dig a little deeper into that?
Yeah, absolutely. This is a critical point of potential vulnerability.
Mm-hmm.
If foreign investors view this debt restructuring as a sign of financial instability or a weakening of the U.S.'s commitment to its financial obligations, they might become less willing to hold U.S. debt in the future.
Okay.
This could lead them to demand higher interest rates when they do buy U.S. bonds, which would increase borrowing costs down the line. Even more concerning, they might start selling off their existing dollar-denominated assets, which could lead to a significant drop in the dollar's value.
Okay, let's step back and look at the broader economic implications if the Mar-a-Lago Accord were to be implemented.
Right.
What are the main shifts we might expect to see?
So as we've discussed, the central aim is a devaluation of the U.S. dollar, which is intended to correct those international trade imbalances.
Yeah.
However, a weaker dollar has a double edge.
Okay.
While it could boost exports, it also carries a real risk of inflation.
Okay.
If the dollar loses value, the price of goods imported into the U.S. will likely rise.
Mm-hmm.
And those higher costs can ripple through the economy, leading to increased prices for consumers across various sectors.
Right.
Think about everyday items that rely on imported components or raw materials.
But on the positive side, the document suggests a potential boost for U.S. manufacturing and agricultural exports.
Yeah.
How would that play out?
So the core principle here is that a weaker dollar makes goods produced in the United States more affordable for buyers in other countries.
Okay.
This increased price competitiveness could lead to greater demand for American-made manufactured goods and agricultural products,
Right.
potentially revitalizing these sectors and creating more jobs within the U.S.
Now, what about the reaction from foreign investors more generally? We've talked about the debt aspect, but how might this impact overall investment in the U.S.?
Yeah, this is a crucial uncertainty. If these policies under the Accord make the U.S. economy seem less stable or predictable to foreign investors, they might become more hesitant to invest here.
Yeah.
They might demand higher returns to compensate for the perceived increased risk, or they could simply choose to invest their capital in other countries that seem more attractive. This shift in investment patterns could lead to greater volatility in U.S. markets and potentially impact asset values.
Yeah. Moving beyond economics, what are the potential geopolitical consequences of a strategy like this?
Right.
It sounds like it could definitely stir things up on the international stage.
Absolutely. The unilateral imposition of significant tariffs, as outlined in Phase 1, could easily strain relationships with even long-standing allies.
Okay.
These countries might view such actions as protectionist and even as a hostile trade move, which could weaken diplomatic ties and undermine established international alliances.
Right.
Think about how countries might feel if they suddenly face significant new costs to sell their goods in the U.S.
Yeah. And what about the already complex relationship between the U.S. and China?
Yeah.
How might the Mar-a-Lago Accord affect that dynamic?
So this is a really critical area.
Yeah.
The Accord directly challenges China's export-driven economic model, which relies heavily on maintaining trade surpluses.
Right.
This could very likely intensify existing tensions between the two nations.
Yeah.
Not just on economic fronts, but potentially spilling over into other sensitive areas such as Taiwan or their respective influence in the South China Sea. It's important to understand we're discussing the potential for an acceleration of these tensions based on this proposed approach.
Yeah, it even raises the possibility of global realignment with countries potentially forming new economic blocs.
Yeah.
How could that scenario unfold?
Well, if multiple countries feel targeted or disadvantaged by the Mar-a-Lago Accord,
Mm-hmm.
they might be motivated to create new economic partnerships and alliances among themselves.
Okay.
This could potentially lead to the development of trade and financial systems that operate outside of the traditional U.S.-dominated sphere,
Yeah.
effectively fragmenting the global economic order into competing blocs.
And the document even mentions the risk of proxy conflicts.
Yeah.
That sounds quite concerning.
It is a concern. The worry here is that economic pressure exerted through tariffs or other measures could destabilize already fragile regions. Countries that are heavily reliant economically on nations targeted by the Accord might find themselves in precarious economic situations, potentially leading to internal unrest or becoming pawns in larger geopolitical power struggles.
Now, for many of our listeners, the potential impact on Canada is going to be a key question.
Of course.
What could the Mar-a-Lago Accord mean for our neighbors to the north?
So, interestingly, the source material suggests that Canada might be considered for an exemption from the direct imposition of tariffs.
Okay.
However, it's crucial to understand that even without direct tariffs, Canada wouldn't be immune to the effects.
Right.
The deeply integrated nature of the North American supply chains means that disruptions in the U.S. economy and trade policies will inevitably have ripple effects across Canada.
So even without facing tariffs themselves, Canadian businesses could still feel the consequences.
Absolutely. Changes in U.S. trade policy will inevitably create shifts in the interconnected North American economy. Furthermore, if the U.S. dollar weakens as a result of the accord, the Canadian dollar could strengthen, making Canadian exports to the U.S. and other international markets more expensive, potentially harming Canadian exporters.
Are there any potential silver linings for Canada in this scenario?
Well, maybe.
Many possible benefits?
The document does suggest a potential increase in demand for Canadian professionals in certain specialized areas,
Okay.
particularly in consulting and trade advisory roles.
Okay.
As trade regulations evolve and businesses need to adapt their supply chains, there could be a greater need for expert guidance in navigating this new landscape.
So let's switch gears a little bit and talk about the potential winners and losers within the U.S. economy itself if this accord were to be implemented.
Right.
Which sectors might benefit?
So based on the analysis, several domestic sectors could see potential gains.
Okay.
These include domestic manufacturing, which would benefit from increased competitiveness due to a weaker dollar and tariffs on imports. The defense and aerospace industries, which often see increased support under America First policies.
Right.
Supply chain consultants, who would be in high demand to help businesses restructure their operations. Agri-tech and food production, which could see increased export opportunities. And cybersecurity and risk analysts, as economic and geopolitical uncertainties tend to drive demand in these fields.
And on the flip side, which sectors might face significant challenges?
So several sectors are identified as potential losers.
Okay.
These include retailers that heavily rely on imported goods as they would face higher costs due to tariffs. Multinational corporations with complex global supply chains, which would likely need to undertake costly restructurings of their operations.
Right.
Technology firms that are heavily dependent on components sourced from Asia, as tariffs would increase their input costs. And financial services tied to global capital flows, which could be negatively impacted by increased investment volatility and shifts in international finance.
Okay, so to bring it all together, what's the main takeaway when we look at the Mar-a-Lago Accord as a whole?
Well, the Mar-a-Lago Accord, as it's proposed, represents a potentially fundamental shift in U.S. economic policy.
Yeah?
It's a combination of protectionist trade measures, primarily through tariffs, and a long-term fiscal strategy centered on sovereign debt restructuring, all aimed at redefining the nation's economic relationships with the rest of the world.
And the primary objectives driving this proposed shift are pretty clear, aren't they?
Yes. The overarching goals appear to be a revitalization of American industrial strength and a reduction in the nation's reliance on foreign economies for critical goods and services.
But as we've discussed throughout this deep dive, this is a strategy that comes with some significant potential downsides.
Absolutely. The strategy carries substantial risks, including the very real possibility of increased inflation for American consumers, the likelihood of retaliatory actions from other countries that feel targeted by the policies, and the potential for broader instability in the global geopolitical landscape. So the interconnected global economy could indeed experience some significant and unpredictable changes if a path like this were to be pursued.
Well, this has certainly given us a lot to consider.
Yeah, it has.
Thank you for taking this deep dive into the Mar-a-Lago Accord with me.
My pleasure.
It's a complex proposal with potentially far-reaching consequences
It is.
that our listeners need to be aware of.
Yeah.
So for you, the learner, as you consider how interconnected our world truly is, how might a strategy primarily focused on national economic interests ultimately reshape the landscape of international cooperation, regardless of the initial intentions behind it? It's definitely a question worth pondering. If you'd like to delve further into this topic, you might find it valuable to explore the history and impacts of major global trade agreements, the intricate mechanisms of currency devaluation, or the ongoing shifts in global power dynamics. Thanks for joining us for this deep dive.
Thanks for having me.